Hello everyone, this is Nikhil here. In today's video, we will actually go through a balance sheet in detail and understand the various terms which are actually there in a balance sheet so that when you want to invest in any business or you want to buy stocks of a particular company, you will know how to analyze and understand a balance sheet before actually making that investment. In the previous video, I had given a brief overview of what exactly balance sheets are and what exactly are assets and liabilities. If you haven't seen that particular video, you can check that out in the description below. Now, like I had previously mentioned, analyzing a balance sheet is very important. If you try to invest in any business without going through a balance sheet or the income statement, it's like you're just blindly throwing your money based on what other people are saying, and that's very risky. So, with that said, let's get into it. Now, this is a balance sheet of Reliance Industries. Now, let's start with the first part of the balance sheet, which is the equity and liability. Now, all the amount which is mentioned on this balance sheet is in crores. Now, a company raises its fund in two ways. One being the loan from the bank, which would be the debt financing, and second would be the equity financing. Equity financing is the amount which the company raises by selling its shares to the shareholders. So, these are the two ways a company raises its fund. Now, the very first thing under the equity and liability section is a shareholders fund. So, this is basically the money which the shareholders have invested into the company. Now, there are two parts: share capital and reserves and surplus. Share capital is the money which the investors or the shareholders invested into the company as per its face value. So, for example, Reliance Industries, they have issued around 100 shares, and each share has a face value of 10 rupees. So, that's a total of 1000 rupees because 100 into 10. If you guys don't know what a face value is, it's basically a value of the share which the promoters of the company kept when they started the company. This is different from the market value. So don't confuse yourself between the face value and the market value. So this 1000 rupees would be the share capital of the company. Now the bigger question is, why is this amount added to the liability section? Because the company doesn't even have to pay the amount back to the shareholders. If the company has taken a certain amount as loan from the bank, they have to pay it back to the bank with interest. But to the shareholders, they don't have to pay the money back unless they're trying to buy back the shares. And they don't even have to pay the interest to the shareholders. So the reason it's a liability is because when a shareholder buys a certain percentage of shares, they become a small owner within the company. Now, obviously, if the company does well and makes profit, it will impact the shareholder as well. Company will have to pay dividend to the shareholders. And even if the company is not paying out a dividend but is keeping the profit completely to reinvest into its own business, even then it's considered as a liability because it's the shareholders' money and the amount was supposed to go to the shareholders. Your reserves and surplus basically tells you about the money which the company has raised from the shareholders and is allocated for some future business, and also the profits which are reinvested into the business every year after paying out dividends. If you guys want to earn passive income from dividends, I have made a separate video on that as well. You can check out that particular video after this one. So, reserves and surplus is the money the company has set aside for future needs. For example, if the company is in the IPO stage, they don't sell the shares at the face value. During IPO, there's always a premium charge. So, for example, Reliance face value is 10 rupees, but during IPO, it might sell at 100 rupees. So, the balance amount is added to the reserve and surplus section. Next, in the liability section, you have two main things: non current liability and current liability. Non current liabilities are your long term liabilities, which are basically for more than 1 year, and current liabilities are your short term liability, which is basically anything less than 1 year. Now, let's start with non current liability. Under non current liability, you have long term borrowing. This basically includes loans which the company has borrowed with a pay back duration of more than 1 year. Now, this is quite important to check because this tells you how much money or how much debt a company has to actually pay back in the next couple of years. Now, if this number is a big number, it can be a concern because tomorrow the business can be slow as well. or the economy can go down like it's happening right now due to coronavirus. So more loan or more long-term debt the company has, it's a small red sign as the company will have to pay interest on the loan even when the business is quite low. It's like today I have a job and I bought a car using a loan. Now tomorrow if I lose my job, touch wood, I hope I don't, I still have to pay EMI for the car. The bank would still need its money back with interest. Next in this section would be deferred tax liabilities. This is basically the amount or the taxes which the company hasn't paid in the past and is yet to pay. This amount needs to be paid in the future. Next would be long term liability. This is nothing major as such. This would basically include debts which are due for more than 1 year. Next would be a long term provision. This is basically the amount which the company has set aside for future needs. Now, for example, if a company has a product and there is a warranty on the product, then the company keeps a certain amount of money aside for the warranty purposes, or the employee gratuity which the company has to pay to the employees. So the company keeps a certain amount of money aside for these purposes. If the company keeps this fund for more than 1 year, it's a long term provision. And if the company keeps this fund for less than 1 year, it's a short term provision. So these would be considered as a liability. When a situation happens, a company might not have ready cash with them. Hence, they keep long term funds allocated. So I hope everyone is clear with non current liabilities. Our next part would be current liability. Like I said before, this would be short term liability or basically liability for less than 1 year duration. You also use current liability to understand the working capital of a company for that particular year. All this amount under current liability, the company has to pay back within the next 1 year. So, under current liability, the first term would be short term borrowing. So, this would be the amount borrowed by the company for less than 1 year. Example, loan with a duration of less than 1 year. Next would be trade payables. This is basically that amount where the bill is already made and is given to the company, but the amount is yet to be paid. So normally, the suppliers, when they give raw materials to the company, they usually provide raw materials on a credit, where the company can pay back within 30 to 90 days. So all that amount which the company has to pay to the suppliers will come in trade payable. And the last term under the liabilities is the short-term provisions, which I had mentioned previously. Let's say you have a gratuity payment coming up, or you have a warranty which has to be paid out. So basically, those funds which the company has allocated for short term users, basically for less than 1 year purpose. So once you have gone through the liability section, it is also important that you check the debt to equity ratio. So in this, you basically add a long term borrowing and short term borrowing and divide the total by the equity. So in this case, when you add the numbers and divide it, it's 0.38 times. If this number is higher than 1 or closer to 1, it's again a red sign. So this was an entire explanation of the liabilities side within the balance sheet. Hope you guys have enjoyed the content and have understood whatever was discussed. Make sure you smash the like button and subscribe as well if you found the content useful. Also, if there is any particular questions regarding this topic, feel free to comment them below or just drop me a message on my Instagram or LinkedIn and I'll try to get back to you as soon as possible. So with that said, see you all in the next video.